Fuck your fucking options. Fuck your fucking zero DTE calls. Fuck the economy. Fuck inflation. Fuck your soft landing. I am sick of this shit. Fuck Wall Street. Fuck you all. I'm fucking out.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks diverged on Thursday with more tech exposed gauges coming under pressure after Oracle's earnings revived AI overspending worries, but the broad market gained on rate cut hope expectations as well as the Fed's new bond buying program. We did see the mega caps take a beating, particularly the AI exposed areas. Google was down 2.93% after Oracle's earnings saw the entire tech trade fall. Oracle was down 12.5%. Ugly day here for Oracle, despite what I thought was an actual fantastic quarter and generally like positive things for the AI trade in aggregate. Amazon and Tesla were down about 1% each. Apple fared pretty good along with Microsoft right here. That did help the tech sector, and then the entire semi space really took it on the chin, particularly Nvidia, AVGO, AMD, MU, Intel, semiconductor equipment manufacturer names. Software was actually alright, particularly the application names. They were doing alright along with infrastructure. However, if you sort of exclude this component here of the market, right, so you sort of take away the tech trade, everything else was actually really, really green through and through. I mean, this is what the market looked like. There was only three sectors in the red here. It was communications, tech, which was the worst performer, and then energy. And even tech was down less than 1% after Oracle's earnings. I think that's a fairly resilient day. However, the S&P 500 did only stay flat because communications and technology are such a big weight in the market. But if you were exposed to the Dow, the Russell 2000, the broad market, you did really, really well. I mean, everything was just gaining today. I mean, excluding real estate, right, staples and discretionary, we saw utilities up 0.6%, healthcare up, industrials up, financials up, materials up, gold was up 1%. A very, very solid day for the broad market in aggregate. This is what the factor analysis looks like. Small cap stocks really, really, just powering forward, up 1% across value, core, and growth. Mid caps also put in the work, especially in the value and core parts of their market growth. Saw some gains as well. And then large caps were the worst performer. You could see here that large cap core was actually red. The growth component didn't do too well. However, the value component of the large cap space was up 0.73%. So all in all, we actually just saw, gains across the value part of the market right here, and then, particularly smaller in size. And this is coming off what I thought was actually like a pretty good economic data, especially for rate cut expectations in 2026. Now, we're not expecting a rate cut in January or February. We're looking for one in March. And we got some initial jobless claims data that wasn't the best, 236,000 versus the consensus of 220,000. However, what's not on this list is continuing claims. That actually did fall, which is a good thing. So we did have a bit of a balance in the initial jobless claims data, and the initial claims came in lower than the expectations. They fell on a week over week basis. So all in all, mixed economic data, but data that does support a slightly weakening of the labor market and tempering of inflation expectations. But the big reason why I think we saw small caps and mid cap stock rally today had to do with yesterday's Fed meeting. Now, to summarize, the Fed cut the Fed cut rates by 25 basis points in the third cut of 2025. The Fed will consider extending and timing of additional adjustments. In other words, they're unsure as to what the rate cut picture will look like in 2026. The market right now is still pricing in 2 cuts for March and June. The Fed will also begin purchasing US Treasury bills on December 12th, which is today or tomorrow or Monday, right? And they're going to start with $40 billion. Now, many people see this as QE. I don't think it's actually QE specifically. I think they're just really doing this to normalize some of the anxiety we're seeing in the SOFR markets, right? And that should actually ease rates up in those overnight repo markets as well. FOMC members Schmidt and Goolsbee dissented in favor of no change, and the Fed did signal that cuts may be done for now, but the market not quite believing that. What also did help the market move today was Tom Lee. He came out and said he expects the S&P 500 to hit 7,700 in 2026, and sort of we got a whole bunch of big banks coming out and putting their targets between 7,500 and some as high as 8,000. So, markets, big banks, asset managers continue to see momentum expanding in 2026, and that is ultimately keeping the broad market trade alive. And then when we look at some of the big market movers, now let's talk about Oracle here, guys, really quickly. Now, Oracle's stock fell as much as 15% on Thursday after the tech firm's quarterly AI costs rose above Wall Street's expectations and revenue fell short. Now, Oracle reported capital expenditures of $12 billion for its fiscal second quarter after the bell Wednesday, up from about $4 billion in the previous year and roughly $8 billion projected by the analyst tracked by Bloomberg. Oracle also hiked its guidance for the full year capital expenditures to $50 billion from its prior $35 billion estimate, and the market just didn't like that at all. At the same time, Oracle reported revenue of $16.6 billion for the fiscal second quarter, up 14% from the previous year, but lower than the $16.21 billion projected by the analyst tracked by Bloomberg. So we sort of have this big backlog growing. CapEx is growing, but we're not really seeing the revenue thrust just yet. We'll see what happens the next quarter. And, those two confluences, the market just doesn't like at all. Nvidia, on the back of this, was down as much as 3.5%, just as the AI industry continues to worry that, hey, where's the revenue from all of this overspending? Will we eventually get it? But for everything we saw today, there was actually 3,800 advances, 2,400 decliners, great market breadth, inflows in the New York Stock Exchange, outflows in the Nasdaq, the S&P 500 largely flat. And when we look at our market momentum indicators, guys, things are looking really good across the board. Don't buy into the fear. Longer term, shorter term, and our medium term averages are solid. And this is telling us that momentum will continue to move to the upside, especially if some of these mega caps begin to participate into this year-end rally. Now, guys, stocks across the globe will actually fit through. Excluding the Nasdaq 100, which was down 0.53%, we know why. The tech trade, Oracle's earnings, etc. Everything else was actually really positive. Even the S&P 500 up 0.17%. But the Russell 2000 gaining, the RSP gaining, that's the equal weighted S&P 500 mid caps gaining. Profitable small caps up 1.13%, equal there with the Russell, and you could see value outperforming growth. Internationally, stocks were fairly mixed as well. You could see European stocks, the stock 600 up 0.5 percentage point. Middle Eastern stocks kind of flat. China stocks fell. India stocks was up about 0.5%. Mixed price action. Crypto really took it on the chin, as you can see right here. Bitcoin was the best performer. Ethereum was the worst. Solana in between. Yeah, crypto not doing too well. But again, a bit of digestion that we are seeing. And I think we are going to start to see liquidity come into the market. And that is why we're still holding key levels, this 3,000 level, 90,000 here for Bitcoin, etc. And then when we look at some of our macro indicators, when we look at volatility, the VIX, that actually fell today despite what we saw in the mega caps. And that's telling you a lot. Yields also continue to fall. And I think that's why we're seeing some of these mid cap stocks, move higher. Small cap stocks move higher. Cheaper cost of capital. This is one of the biggest input costs as it pertains to margins. A lower cost of capital is immediately margin accretive in the immediate quarter. The second the Fed cuts rates, especially with what they're going to do with those $40 billion repurchase program, especially as it pertains to the SOFR market. I think mid caps and small caps are going to be the direct beneficiaries of that, especially these publicly fit markets, these public companies that can get that capital and have that floating rate debt. The dollar did sink on the back of what we saw, yields falling, but that's to be expected. TLT was roughly flat, and then we saw gold and silver move higher on the back of yields falling. When yields falling, when we have cheaper monetary policy and more dollars in the system, gold, the inflation hedges, is going to do really well. So you can see it, gold and silver leading the charge, and that's eventually going to flow into crypto. But let's quickly talk about the markets at large, the S&P 500. Now, guys, for those of you who don't know, really quickly, this is my whale watching indicator, the newest indicator I got right here. It just tracks huge institutional buys. I don't have sells just yet. I'm still working on that. But whenever this thing goes yellow, it means institutional whales have accumulated in a very big whale. You can see in the S&P 500, it marked the bottom right here. You can see generally, it's very rare on ETFs for the most part. It's more active on like stocks, but it generally marks bottoms. This was the 2022-2023 low right here, and from there we absolutely ripped up. But when we look at the S&P 500, this is the weekly chart, by the way, things looking actually still pretty good. We're trading right here at the top end of the range, near all-time highs. Again, just consolidating a lot of the big move we've seen in the last year and potentially in the last 2 years. Just a bit of consolidation. It happens. Like we had consolidation right here towards the end of 2024. We may have a little bit of consolidation and chop our way to the top, but ultimately, I do think we need to lean constructively bullish in 2026, especially with where the earnings picture is right now. And hop it on the daily chart. You can see a little bit of nuance. You can see that this is the tariff tantrum lows right here, and we have had a bit of a pullback, a rally, digesting the gains, but it does look like we are poised to go and retake some of the highs. Now, look, we did have a pretty ugly day here yesterday on Wednesday. I mean, you could sort of see that we gapped down, moved higher, right? And then today we moved all the way, nearly retracing back to yesterday's open. So very, very crazy to see, you know, the move on the FOMC, the pullback in the overnight markets, and now the recover back to yesterday's highs. This is constructive. This is the market telling you, hey, I think rate cuts are likely going to help this market, and they're going to help this market, especially in the broad market. Now, looking at the RUT, the Russell 2000 is breaking out. That's the all-time high, guys. The Russell 2000 is breaking out. We're in price discovery. I mean, let's go on the weekly chart. You can see right here, we're in price discovery. That is the all-time high. This is 2024. I mean, if we scroll out, we're breaking above the all-time highs, as you can see right here for the Russell 2000 price discovery, and that's really, really constructive. But it's also true for the RSP. Very, very solid stuff. This is exactly what we wanted to see, the broad market breaking out. And look at all these institutional buys in the RSP right here. You know, institutions were loading up, and look at where we are right now. Absolutely insane. Now, how do we play the Russell 2000? I think you want to look at names like EOSE. This is a name I've been championing for a very long time. You know, we were big buyers right here. You can see institutions came in a very, very big way at these lows, up 7% today. And I do think we're probably going to see the $20 region here for a name like this. Another name I do like in the small cap space, potentially moving into a mid cap, is Lemonade. You can see right here, institutional buyers came in right here, right here, right here. Then if we actually zoom out on this daily chart, had you taken where those institutional buyers came in, right, you'd be sitting very, very pretty. And now, while this isn't all-time highs for Lemonade, because all-time highs is closer to the $300 mark, this is very close to a 52-week high. And if we close, there will be a 52-week closing high for Lemonade. I think this is a great stock. This is a great way to play the small cap space. I also do like APLD, Applied Digital Corporation. They've done really, really well. You can see they've moved all the way up here, reached the 34 mark. Now we are pulling back as long as we put in a higher low relative to this low right here. Let's say we pull back and then make our next move. We break these highs. We can then go ahead and retake all-time highs. The only problem, the only time this becomes a problem is if we go ahead and break these lows. And I don't think that's going to happen. I think we're going to see $35, $40 APLD before we actually see the $20 mark. Again, watch this space. In my personal opinion, that's at least what I'm thinking for the most part. So that's where I would say you want to put your money. Another one could be in Iris Energy. Again, a lot of this is positive to the AI data center trade. Now, yes, I get it. The stuff with Oracle is a little bit concerning. However, I think for the most part, all of Oracle's stuff was a net positive for the AI trade going into 2026, 2027. And if you want to stay away from these small and speculative names, maybe look at Google, right? It is pulling a bit back. You can see right here, sort of basing, sort of pulling back. I mean, if we get to this $300 area, potentially as low as the $275, I think you want to load up Google right here. Look, it's not cheap anymore. It was cheap at 21 times. It's now trading at what, maybe 28. But you're buying one of the best in class operators with just some of the widest moats across everywhere. They have the number 1 and number 2 biggest search engine in the world in Google and YouTube, Google search, I mean. So yeah, this is definitely a place where you want to be. And another place where you want to be is Nvidia. Also pretty much trading at its highs, basing out. And if you want a stock that's pulled back significantly, we can also look at Meta Platforms. I don't think the stock is out, but you know, they are about 20 to 30% off their highs. Yeah, the $700 area, you know, getting to as low as the 580. Seen a bit of a bounce back. Institutions were accumulating sort of on this downtrend near these lows. And these lows right here, when we see a lot of institutional buys, it normally is a positive sign that we will eventually go higher. But let's quickly look at the crypto trade. Bitcoin, I mean, constructively still looking very, very bullish. It is trepid in terms of the price action. Institutions were certainly loading up at these lows right here. In fact, they were loading up all the way down. I find crypto, the whale indicator works better on the weekly chart than it does the daily chart, but we see a massive buy right here, institutions coming in. And I do think we are going to drift higher. We are making higher highs, higher lows again in this trend, and there's still definitely a lot of upside to be had here for Bitcoin. For Ethereum, very similar situation. I do think we are pulling back after, again, if you take a measured move from peak drop, right, 33% move off those lows. We're just pulling back after a 33% move, and I think we're going to find support and then continue the move higher here in this space. Gold was up 1%. I think gold's going for those all-time highs. I think silver just keeps squeezing. I mean, look, $60 on the table here for silver. I mean, guys, we got rate cuts. We're likely getting more rate cuts. We got a Fed bond buyback program, right? It's not QE, but it's definitely going to help rates and the SOFR markets move lower. That's going to be bullish for commodities, debasement hedges, Bitcoin, crypto, risk assets. You want to hold assets, buy high quality operators, still stay exposed to the AI trade. I do think stocks go higher in 2026. Guys, and diving into sentiment, the fear and greed index continues to be right here in fear. Guys, you know we are about 1 to 2% of all-time highs. You think if that was the case, we would be here in greed, in extreme greed as the market continues to plow higher. But a lot of the fear in the market is still there. And again, like I always say, it is simply fuel for the upside. But we do have to understand that here, on the 9th, the 10th of December, we can actually see a little bit of a pullback to the middle of the month. In fact, we can actually almost get back to break even. So a lot of the volatility we are seeing now in the market, that's completely normal, but we do have to understand that the path of least resistance towards the end of December continues to move higher. So we are in a seasonally bullish time period of the year. Again, this is for the S&P 500 and we should expect higher highs. And guys, something else we do have to note is small caps. Now, small cap ETFs have seen a massive $20 billion in cumulative outflows this year, even though the Russell is up 13% for the year and more than 40% off its April lows, right? But on a more tactical basis, the rolling 63-day flows into small cap ETFs have officially turned positive at the end of October. That's a pretty big shift in sentiment considering that the trailing 3-month ETF flows have remained negative for the last 8 months straight, something we haven't seen in recent years. In my opinion, this is the early stages of a sentiment inflection and shift. Now, looking at the macro, guys, we do get a lot of momentum and talk on Twitter about the credit market, the consumer, but when we look at high profile defaults and we look at them at the beginning of a credit cycle, normally they actually do move higher. As you can see right here, credit defaults at the moment are actually falling. And that's really a good thing. And, while they are a little bit elevated, relatively speaking, they are moving in the right direction. Looking at the market for US Treasury securities, it officially surpassed 30 trillion for the first time, having more than doubled in size since 2018 as the pandemic era borrowing surge takes its toll. And this ultimately is why you want to continue to hold assets, right? The government is, technically insolvent, and that means more money printing in the future. That money will flow into assets as the government continues to debase its currency. Now, looking at earnings for the rest of the week, tomorrow we have Chewy and then Oracle and Adobe. Those are going to be the two big ones here after the close, especially Oracle's earnings. A lot is going to be focused on that. And then we have a couple of big names there on Thursday. In terms of data tomorrow, Wednesday, guys, the big ones are going to be the FOMC. Everybody's going to be focusing on this, as well as the monthly budget statement, the press conference. And you also get the employment cost index right here. I think a lot of people are going to be watching that guy. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.